Foreclosures are rising again in 2026. But let me be clear, it's not 2008 all over again. What we're seeing is a measured but meaningful shift in the housing market. Distressed properties are starting to come back into focus. Some homeowners are feeling more financial pressure, and buyers are beginning to see some opportunities that have been missing from the market in the last few years. The key is knowing how to respond before the headlines catch up. My thought on this is that if you're a homeowner who is behind, overwhelmed, or unsure of what your options are, or if you're a buyer looking to have a strategic opportunity in this changing market, schedule a meeting with me. I'm David Kowal. I'm a mortgage loan officer as well as a realtor with eXp. Let us sit down, look at the numbers, review your situation, and create a clear plan of action. No pressure, no judgment, just strategy, clarity, and a path forward. I'm David Kowal, and I'm looking forward to having a conversation with you soon. I help buyers, sellers, and homeowners understand the real numbers behind the housing market so they can make smart decisions with confidence and not fear. Today we're going to be talking about why foreclosure activity is rising, what is driving the shift, and what it means for homeowners, buyers, and investors in 2026. Over the last few years, the housing market has been defined by limited inventory, elevated home prices, and strong homeowner equity. Because of that, distressed properties are not a major part of the conversation, but that is starting to change. Recent data shows foreclosures filing are rising year over year. In early 2026, foreclosure activity increased by approximately 20% compared to the previous year, marking the 12th consecutive month of annual growth. In January 2026 alone, more than 40,000 properties recorded foreclosure filings, representing a 32% annual increase. Completed foreclosures, meaning properties that are in transition into lender ownership, have also increased, with some reports showing year-over-year increase of up to 35%. Now, this does not mean the housing market is collapsing, but foreclosure activity is still far below the levels seen during the last major housing downturn. But the trend matters. When distressed inventory starts moving back into the market, buyers, sellers, and homeowners and real estate professionals need to pay attention. So what is driving this shift? Now, it is not one single factor. It's a combination of pressure points. First, affordability is still a major challenge. Mortgage rates are higher than where they were during the pandemic years. Home prices remain elevated in many markets. Property taxes, insurance premiums, utilities, credit card debt, and general household expenses have all increased. That means some homeowners are being squeezed from multiple directions. Second, newer homeowners may be more vulnerable. Many buyers who purchased during the peak pricing periods took on a higher payment, higher purchase prices, and tight monthly budgets. If life changes, job loss, reduced income, divorce, medical bills, major repairs, or rising debt, that payment can become difficult to manage. Third, some government-backed loan segments are showing more stress. Programs like FHA, VA, USDA help many buyers get into homes with lower down payments, and they are valuable tools. But borrowers with smaller cash reserves can be more sensitive to economic disruption. Finally, broader economic uncertainty is playing a role. When more people are searching for mortgage help, payment relief, or foreclosure assistance, that tells us households are starting to feel the pressure. Now, this is not a system-wide collapse, but it's a signal that financial stress is building in certain areas of the market. For homeowners, this is the most important message. Do not wait until the situation becomes urgent. If you are behind on your payments, worried about falling behind, dealing with repairs, facing job loss, or simply unsure of what to do next, you still may have options. A distressed property does not mean that you are out. Sometimes the right move is selling before the situation becomes more expensive. Sometimes it's negotiating with a lender. Sometimes it's applying for assistance. Sometimes it's restructuring debt. Sometimes it is creating a clear exit strategy before late fees, legal costs, missing payments, and stress start piling up. The earlier you look at the numbers, the more control you usually have. There's no shame in needing help. The mistake is waiting too long. Now, avoiding the conversation or assuming there is only one outcome is not the best route to go. You deserve a clear plan before the timeline gets too tight. Now, for buyers, this shift may create opportunity. In a market where traditional inventory has been limited, lender-controlled properties can add another source of supply. These properties may be bank-owned, investor-held, or part of the foreclosure pipeline. Some of them may be priced more competitively than surrounding homes. Some may need repairs. Some may also offer value in areas where affordability has been difficult. But here's a reality. A distressed property is not automatically a good deal. You have to evaluate the condition, the repair costs, the neighborhood, the resale potential, the financing options, appraisal risk, title issues, and true after repair value. The opportunity is not just finding a lower price. The opportunity is finding the right property with the right numbers and the right strategy. That is where having both a real estate and lending professional perspective matters. Now, let me keep this in perspective. Rising foreclosure activity does not automatically mean a housing crash. Today's market is very different from the last major turndown. Now, most homeowners still have significant equity. Inventory is still limited in many areas. Lending standards are stronger than they were before 2008. And foreclosure activity is still far below historical crisis levels. What we are seeing is more of a market normalization. For several years, distressed inventory was almost absent from the market. Now, because of the higher cost, the financial pressure, it's slowly reappearing. That does not mean panic. It means preparation. Now, smart buyers, sellers, and homeowners do not wait for the market to become obvious. They pay attention to the signals early. So here's the takeaway. Foreclosures are rising in 2026, but this is not a market collapse. It's a sign that homeowners are under more financial pressure and that distressed properties are becoming relevant again. For homeowners, this means you need to understand what your options are before the situation gets worse. For buyers, it means that there are many opportunities out there, but only with serious due diligence. For investors, it means that distressed inventory may become more important part of the market again. And for anyone watching the housing market, this is a trend worth paying attention to. Now, if you're behind, overwhelmed, looking for options, or trying to figure out whether buying a distressed property makes sense, schedule a meeting with me, David Kowal, Lender Realtor. We will be looking at your situation, reviewing the numbers, and build a plan of action that fits your goals. Message me the word plan or use the link in the description to schedule your consultation. Thank you so much. Have a wonderful day. Take care.